How to get a loan when you're self-employed. If you own your own business and self-employed, you may wonder, how hard is it to get a mortgage? This is John Werner with Mortgage and Credit Pro. Today I'm going to talk about loan program options, qualifications, and requirements for self-employed borrowers. W-2 wage earners can generally qualify for a home loan by simply providing their W-2s and pay stubs and verification that they have a job. When you own your own business, things are a bit different. In this video, I will break down some of the general requirements for self-employed borrowers. To qualify for a home loan, we will begin with an important rule, verifying how long you have to be self-employed. Most lenders and loan programs require that you have been self-employed in your current business for a minimum of 2 years. Lenders define self-employed as a borrower with an ownership interest in a business of more than 25% and not being a W-2 employee. However, there is exceptions to the rule. You might qualify with just 1 year of self-employment if you can show a 2-year history in a similar line of work. You'll need to document an equal or higher income in the new role compared to the W-2 position. Some lenders will even count 1 year of related employment plus 1 year of formal education or training as good work history. If you meet the self-employment history requirements, the next thing your lender will ask for is 2 years of tax returns. After analyzing the tax returns, if you are not showing enough income to qualify, you may want to ask your lender if they offer an alternative loan program verifying your income based on your bank deposits into your bank account. Mortgage lenders will generally consider any stable, consistent, and ongoing source of income. All kinds of self-employment income are eligible for a mortgage. For example, business owners, freelance income, contract workers, seasonal work, and side jobs. These income types can be considered on their own or in addition to a primary income. A lender must determine whether any source of income will be ongoing and the income seems likely to continue for at least 3 years after closing. If there is a decline in income, it will not be able to be counted. Underwriters use a formula to generate qualifying income for self-employed borrowers. They start with your taxable income and add back in certain deductions like depreciation, since that is not an actual expense that comes from your bank account. Business owners and self-employed workers often take as many deductions as possible. While this can save you a lot of money when it comes to be tax time, it can hurt you when you're trying to get approved to purchase a home. This is where a bank statement loan program could be a viable second option. How does a lender document self-employment? In most cases, self-employed borrowers will need to provide 2 years of personal tax returns, 2 years of business tax returns, including K-1s, the 1120 business license, a year-to-date profit and loss, a balance sheet, and a signed CPA letter stating you are still in business. If the business is a sole proprietorship, not a partnership corporation or an S corporation, you may not have to provide business tax returns. If you've been self-employed at the same business for 5 years or more, you may only have to provide 1 year of business or individual tax returns instead of 2 years. Many businesses go through ups and downs. It helps to prepare a letter explaining any significant year-over-year decrease in income when you apply for a mortgage as a self-employed borrower, to help explain why the lender should count the income. You don't have to own a business to be considered self-employed. A lender will consider you as self-employed if you own 25% more of a business and receive a 1099. If you're part ownership of a business but own less than 25%, you're not considered as self-employed for a home loan. You are not required to report self-employed income under Fannie Mae and Freddie Mac lending rules if you have a freelance job or a small business on the side and you don't need the income from it to qualify. Your lender can ignore it on the application. You may wonder if you can get a joint mortgage if one person is self-employed Maybe you want to apply with a spouse or a co-borrower, but one is self-employed and the other is W-2'd. Mortgage lenders will be okay with this provided the self-employment income meets the guidelines and both applicants meet loan requirements. You also have the option not to count your co-borrower's income if you wish, if you qualify for the loan with your income and your co-borrower is self-employed. Your lender can ignore that business in underwriting. Why would you want them to do this? Because many small ventures or even large startups don't show income on tax returns, at least on paper. They generate losses. While business write-offs are significant for reduction in taxes, they can reduce your taxable income when you're applying for home financing. If you're self-employed and want to buy a home, it helps to plan ahead. Work with a mortgage professional like me. Self-employed borrowers have access to the same mortgage programs and low rates as a W-2 borrower. Be sure to work with a lender that has all the loan programs for self-employed borrowers. Thank you for watching. If you want to purchase or refinance a home or have questions about the mortgage process, don't hesitate to reach out. My contact information is below. Can you do me a huge favor and subscribe to our channel? And also too, if you have any subjects you would like us to cover in the future, please put in the comments below.